It happened again. $40 billion vanished from silver markets in less than 72 hours. If you're watching this on February 10th, 2026, you just witnessed the second catastrophic crash in 14 days. On January 30th, silver hit $121.64 per ounce, an all-time record that took 45 years to reach. 8 hours later, it was trading at $76. That's a 37% collapse in a single trading session. The media told you it was Kevin Warsh. They blamed Trump's Federal Reserve Chairman nomination for the panic. But here's what nobody reported. The crash started 3 hours before Warsh's name was even publicly announced. At 10:30 a.m. Eastern, silver was already down 27%. The news broke at 1:45 p.m. Connect the dots. Something triggered the largest precious metals liquidation since 1980 before the official narrative even existed. Then it happened again. Silver recovered to $92 by February 4th, as traders thought the worst was over. 4 days later, it crashed back to $76 on February 8th. Another $16 drop, another wave of forced selling. Today, it's trading at $82, and the pattern is undeniable. This is not normal market volatility or investor panic. This is engineered chaos. Systematic liquidations designed to transfer wealth from retail traders to institutions. The mainstream financial media will not explain this to you. They cannot explain what they don't understand. CNBC blamed algorithms. Bloomberg blamed macroeconomic uncertainty. Reuters blamed technical support levels breaking. None of them mentioned the real mechanism. The margin calls that force leveraged positions to liquidate at exact lows. None of them showed you the CME data that proves banks were buying physical silver while the paper price collapsed. I'm going to show you exactly how this wealth transfer works, the mathematics behind forced liquidation cascades, the settlement mechanics that allow institutions to acquire metal at 40% discounts during manufactured crashes, the futures contract structure that guarantees retail traders lose while commercial banks accumulate at predetermined prices. This is not conspiracy, this is market architecture. And once you understand it, you'll never view price crashes the same way. Let me start with January 30th. The day silver lost $45 in value before most Americans finished their lunch. The price opened in New York at 121.18. Within 90 minutes, it had dropped to $103. That's an $18 free fall. By 1 p.m. Eastern, it touched $87. By 3 p.m., it briefly hit $76 before recovering slightly to close at $81 for the session. That's a 12 sigma statistical event, an occurrence so improbable it shouldn't happen once in 7,000 years. But it did happen. And 14 days later, on February 6th, it happened again with a $16 intraday crash. The question everyone should be asking is simple. How does a market lose 40% of its value twice in 2 weeks? The answer lies in leverage, in margin requirements, in the mechanics of futures. Contract liquidation nobody explains on TV. When silver was climbing from $90 to $121 in mid-January, retail traders were piling into leveraged long positions. Futures contracts, options, leveraged ETFs, positions that require only 10 to 20% cash collateral to control. As the price rose, traders felt vindicated. They added more contracts. They increased their exposure at higher and higher prices. What they didn't understand is that leverage works both ways, and the higher the price climbs, the more dangerous it becomes. When silver hit $121 on January 30th, the total open interest in COMEX futures contracts exceeded 900 million ounces. The entire global annual mine production is only 830 million ounces. Think about that mathematical impossibility. Paper claims on silver exceeded physical production by 70 million ounces. The system was completely over-leveraged. Before we continue, I need you to do something critical. Hit the like button on this video right now while you're thinking about it. YouTube's algorithm suppresses financial content that exposes institutional mechanics. Every like fights that suppression directly. If this analysis is valuable to you, help it reach the people who need to understand what's happening in commodity markets. That's how we build awareness. One view at a time, one share at a time. Hit that button now before you forget. Now, let me show you exactly how the wealth transfer mechanism works. The part nobody explains on financial television. The CME Group controls silver futures trading through the COMEX exchange. They set the margin requirements for every contract. When silver was climbing from $90 to $121 in mid-January, retail traders were euphoric. They were buying futures contracts with 10 to 15% cash collateral, controlling 5,000 ounces per contract. A single silver futures contract at $120 represents $600,000 of notional exposure. The margin requirement to hold that position was only $60,000. That's 10 to 1 leverage built into the system. As the price climbed, traders kept adding positions. They felt validated. They thought they'd found the trade of the decade. What they didn't understand is that margin requirements are not static. The CME adjusts them based on volatility assessments. On December 30th, The CME raised silver margins by 30%. They called it a routine volatility review for adequate coverage. Then they raised them again on January 8th, another increase effective after Friday's close to account for price movements. By late January, silver margins had been hiked more than half a dozen times in just 10 weeks, according to exchange records. Here's what that does to leveraged positions. If you bought a contract at $100 with $60,000 in margin, you're fine. But when the CME raises requirements to $90,000 and the price starts dropping, you get a margin call within hours. You either deposit $30,000 more cash immediately, or your broker liquidates your position automatically to protect themselves. Multiply that by thousands of retail traders all receiving margin calls simultaneously, and you create a forced liquidation cascade. The selling pressure becomes self-reinforcing. Prices drop, which triggers more margin calls, which forces more selling, which drops prices further. This is not organic market behavior. This is mechanical liquidation driven by exchange policy changes during periods of maximum leverage. On January 30th, when silver crashed from 121 to 76, this exact sequence played out in real time. The crash started at 10:30 a.m. Eastern. Kevin Warsh's Fed chairman nomination wasn't announced until 1:45 p.m. that afternoon. For 3 hours, the mainstream narrative didn't exist yet, but silver had already lost 27% of its value by then. What triggered the initial sell-off? According to CME clearing reports, margin requirement changes went into effect after the previous day's close. Thousands of traders woke up January 30th to margin calls, demanding immediate cash deposits they didn't have available to post. Their brokers began automatically liquidating positions at market prices. The sell orders overwhelmed the bid side of the order book. Within 90 minutes, silver dropped $18. By 1 p.m., it had fallen to $87. By 3 p.m., it touched $76. That $76 print represents a 12 sigma statistical event, an occurrence so improbable it shouldn't happen once in 7 millennia. But it did happen. And it happened because the system is designed to create these liquidation events when leverage reaches extremes. Now here's where the wealth transfer becomes visible. While retail traders were being forced to sell institutions, were buying physical metal. CME delivery records from January 30th show JP Morgan accepted delivery of 3.1 million ounces at exactly $78. That's 633 contracts settled for physical delivery at the precise bottom of the crash, according to exchange data. The timing is noteworthy. JP Morgan had been short silver as it climbed to 121, meaning they'd bet against the rally. Those short positions were underwater by billions as the price rose. Then the margin hikes triggered the cascade they needed to exit. At $78, they closed their shorts and simultaneously took delivery of physical metal at a 40% discount from the peak. This wasn't illegal. It was structural advantage. They had access to information about margin changes before public traders understood the implications. They had capital reserves to post additional margin, while retail accounts were being liquidated for insufficient collateral balances. They had relationships with the clearinghouse that allowed them to convert paper positions to physical delivery at exact market bottoms. 4 different profit mechanisms activated on the same day. Short position profits from the crash, physical acquisition at distressed prices, trading commissions from handling client liquidations, and access to Federal Reserve emergency lending that provided the liquidity to execute everything. On December 31st, banks borrowed $74.6 billion from the Fed's standing repo facility, a record by 50%. This facility exists to prevent funding crises, but only eligible institutions can access it. Retail traders don't have that backstop. When the crash came, institutions had unlimited liquidity to buy, while retail traders had forced margin calls requiring immediate selling. The mathematical result was predictable. Wealth transferred from leveraged individuals to capitalized institutions at precisely engineered price levels. This pattern repeated on February 6th, when silver crashed again from $92 back to $76 in another liquidation wave. Same mechanism, margin pressure, forced selling, institutional accumulation at the bottom, a $16 move in less than 48 hours. The difference between January and February is that fewer retail traders had capital left to lose after the first crash wiped out their accounts. By the second crash, the liquidations were coming from the survivors who'd tried to buy the dip and got caught in another squeeze. Today, silver sits at $82. It's recovered $6 from the latest bottom, but the pattern remains intact and ready to repeat. The system creates volatility. Volatility justifies margin increases. Margin increases force liquidations. Liquidations create buying opportunities for institutions. This isn't conspiracy, it's market architecture. The rules are public, the data is available, the mechanism is documented in exchange filings. What's not public is the advanced knowledge of when margin changes will hit and which positions are most vulnerable to forced liquidation. That information asymmetry is worth billions. And it's why retail traders keep losing money in markets they think they understand, but don't. Now here's the part that makes no sense. While silver crashed 40% in 2 weeks, industrial demand hit all-time records. The contradiction is so stark that nobody in mainstream media wants to address it. They can't explain how the most essential industrial metal is collapsing. According to the Silver Institute's December report, industrial fabrication demand reached 680 million ounces in 2024. That's the highest annual consumption in recorded history. Every single category of industrial use set new records during the same period silver crashed. Solar panel manufacturing alone consumed 197 million ounces last year. That number represents 29% of total global demand. In 2014, solar panels accounted for only 11% of silver demand. The sector has nearly tripled its share in just 10 years. Electric vehicle production required 75 million ounces in 2025, according to automotive industry data compiled by Oxford Economics. Each battery electric vehicle contains 25 to 50 grams of silver, compared to 15 to 28 grams in traditional combustion engines. The data center and artificial intelligence sector added another 15 to 20 million ounces of consumption as computing infrastructure expanded globally. Total IT power capacity increased from 0.93 gigawatts in 2000 to nearly 50 gigawatts in 2025, according to industry measurements. AI workloads generate significantly more heat than traditional computing. Silver's thermal conductivity makes it irreplaceable for managing these extreme temperature conditions. The combined industrial demand from solar energy electric vehicles, data centers, and electronics exceeded the entire global mine production for the 5th consecutive year. Total silver mine output in 2025 was approximately 830 million ounces. Industrial demand alone was 680 million. That leaves only 150 million ounces for investment jewelry, silverware, photography, and all other non-industrial applications, combined globally. The mathematics creates a persistent structural deficit. Demand exceeds supply by an estimated 230 million ounces annually, according to market analysis. This deficit has been growing, not shrinking. In 2021, the gap was 100 million ounces. By 2025, it had more than doubled. So explain this to me. If industrial demand is at record highs and supply deficits are widening, why did silver crash 40% in 2 weeks? The answer is that paper markets and physical markets have completely disconnected. The COMEX price represents futures contracts, not actual metal changing hands. When silver hit $121 in late January, the total open interest exceeded 900 million ounces of notional exposure. But the registered COMEX warehouse inventory available for physical delivery was only 287 million ounces, according to exchange reports. That's a coverage ratio of 3.1 paper claims for every physical ounce. The system functions as long as nobody demands actual delivery. The moment leveraged traders get margin calls and positions liquidate the paper price, crashes regardless of what's happening in the physical market. Meanwhile, companies that actually use silver in manufacturing are paying prices significantly above the COMEX spot quote to secure guaranteed delivery schedules. Premiums on physical silver coins reached $6.50 over spot at major dealers in early February, according to published retail pricing data. That's a 7.8% premium when spot was trading at $83. Industrial buyers report 12 to 16-week lead times for large orders. The London Bullion Market Association silver price has been trading consistently $1 to $2 above COMEX futures for the past 3 weeks. That spread indicates physical demand in international markets is absorbing available supply faster than paper traders can push prices down through contract selling. India became the world's largest silver importer in 2025, with $9.2 billion in purchases, despite prices nearly tripling domestically. Indian silver prices climbed from 80,000 rupees per kilogram in early 2025 to 243,000 rupees by January 2026. China implemented export license requirements for silver starting January 1st, 2026. This policy tightens global physical supply from the world's largest producer. So we're watching two different markets operate simultaneously. The futures market, where leveraged speculation drives violent price swings through margin mechanics, and the physical market, where actual industrial users are competing for limited supply and paying premiums that reflect true scarcity conditions. The question becomes, which market ultimately determines the real price? The answer is always the physical market, because you can't manufacture products with paper contracts. Solar panel factories need actual silver paste to print electrical contacts on photovoltaic cells. EV manufacturers need real silver for battery management systems. JP Morgan's 3.1 million ounce delivery at $78 represents exactly this arbitrage. Buy the paper crash, then monetize the physical premium. The retail trader, who got liquidated at $76, sold to the institution that will profit from the spread between paper and physical markets. That spread is widening, not narrowing. And as long as industrial demand continues setting records, the physical market will eventually force paper prices higher. So what happens next? That's the question every trader watching silver at $82 wants answered on February 10th, 2026. The pattern we've documented across these 2 crashes in 14 days tells you everything you need to know about what's coming in the months ahead. This is not the end of volatility. This is the beginning of a new phase where paper market manipulation collides with physical market reality. The leverage in the system hasn't been eliminated. It's been temporarily reduced through forced liquidation, but it's already rebuilding as traders re-enter positions. According to COMEX open interest data from February 7th, total futures positions have increased by 62,000 contracts since the February 6th low. That's 310 million ounces of new paper exposure, added in just 4 trading days as the price recovered from $76 to $82. The same traders who got liquidated at the bottom are buying back in at higher prices, thinking they can time the next move correctly this time. History says they're wrong. The margin requirement adjustments that triggered both January and February crashes are still active in the CME rulebook. The exchange can raise margins again at any time, with as little as 48 hours notice, to brokers who then have 24 hours to collect from clients. This creates a structural volatility mechanism that will repeat every time silver approaches psychologically significant levels like $90 or $100. The institutions know this. That's why JP Morgan and other commercial banks maintain both long physical positions and short paper positions simultaneously. They profit from the crashes by covering shorts at bottoms, while their physical holdings appreciate during the rallies, creating hedged exposure to both directions. Retail traders don't have this capability. They're either long or short. They can't play both sides with sufficient capital to survive the liquidation events. This asymmetry explains why wealth consistently transfers from individuals to institutions during periods of extreme volatility in precious metals markets. Now let's talk about where the price goes from here. Not predictions, but scenarios based on the fundamental data we've covered throughout this analysis. The supply deficit is real. Industrial demand consumed 680 million ounces in 2024 against production of 830 million. That 230 million ounce annual deficit has to be filled from above ground inventories, which are declining according to Silver Institute tracking data. Registered COMEX warehouse stocks dropped from 340 million ounces in November to 287 million by early February. That's a 53 million ounce draw in 3 months. At this rate, the exchange runs out of deliverable inventory in approximately 15 months. Before that happens, one of 3 outcomes occurs. Either the price rises high enough to incentivize recycling and reduced industrial consumption, slowing the deficit, or producers dramatically increase mine output, which takes 3 to 5 years minimum from discovery through permitting to actual production at scale. Or the COMEX declares force majeure and settles contracts in cash rather than physical metal, which would be an admission the paper market has failed entirely. Bank of America analysts published a January 5th forecast projecting silver could reach $135 to $309 in 2026. That range reflects the potential for a supply squeeze if industrial demand continues accelerating while mine production remains constrained at current levels. Gold Silver's lead analyst expects silver to trade above $100 in 2026 as supply deficits deepen and investment demand increases from current levels. Multiple forecasting models show scenarios ranging from $85 in a moderate case to $175 if investment participation accelerates significantly. These aren't guarantees, they're probability-weighted projections based on supply-demand mathematics and historical price behavior during previous deficit periods. The volatility we've witnessed over the past 2 weeks doesn't contradict the bullish long-term outlook. It confirms it by demonstrating how fragile the paper market has become. Markets that move 40% in 2 weeks twice within 14 days are markets under extreme stress where normal price discovery has broken down completely. The crashes shake out leveraged speculators. The rallies bring them back in. The cycle repeats until either the fundamentals resolve or the system restructures. What you choose to do with this information is entirely your decision. I'm not telling you to buy or sell anything at any price level. I'm showing you the mechanics, the margin call cascades, the physical paper divergence, the institutional arbitrage, the supply deficit mathematics. Understanding these systems doesn't guarantee profits, but not understanding them guarantees you'll be the counterparty to someone who does when the next crash happens. Silver sits at $82 today. It crashed from 121 to 76 and back twice in 2 weeks, creating unprecedented volatility. The pattern is clear, the mechanism is documented, the data is public. What happens next depends on whether the physical market or paper market wins the tug-of-war. That's the analysis. That's the system. That's what nobody explains on financial television because it reveals how wealth actually moves in commodity markets. If this breakdown helped you understand what you just witnessed over the past 14 days, leave a comment below with your thoughts on where silver goes from here. And if you want more analysis like this that cuts through the narratives and shows you the actual mechanics, subscribe and hit the notification bell. This is how markets really work. This is how institutions profit while retail traders lose. This is the pattern repeating itself right now in real time.